Silver crashed over 4% in the past 24 hours. That single number is sending shockwaves through the precious metals community right now, and if you are holding silver or thinking about buying the dip, what happens in the next few days could define your entire position for the rest of this year, because this is not just another red candle on a chart. This is the market telling you something important, but here is what almost nobody is talking about. This sell-off is happening at the exact moment the Federal Reserve just turned hawkish. Welcome to Aurelius Metals. I am here to break down exactly why silver is falling, what the smart money is doing right now, and what could happen next in this unfolding story. Stay with me until the end, because the final scenario could completely change how you view the coming months. Let's start with the catalyst. Silver futures have shed over 4%, extending a brutal multi-session correction. This began right after the Federal Reserve's latest policy meeting. 9 of the Fed's 19 policymakers now favor at least one more rate hike this year. That single data point sent the US dollar index surging to its highest level in 12 months. And when the dollar climbs like this, non-yielding assets like silver get crushed almost instantly. This changes everything for silver investors who got comfortable during the earlier rally, because higher interest rate expectations mean higher real yields. And higher real yields mean holding metal that pays no interest becomes less attractive compared to bonds. It is simple math, but it has brutal consequences. Now pay close attention, because this is where the story gets serious. This is not happening in isolation. Treasury yields have pushed toward 4.2%. That is a direct headwind for every ounce of silver sitting in a vault right now. At the same time, geopolitical tension in the Middle East remains unresolved. Normally, this kind of tension would support a safe haven bid, but right now the dollar's strength is overpowering even geopolitical fear. That tells you something critical about where institutional money is actually flowing. It is not flowing into metal as a panic hedge, it is flowing into the dollar as a yield play. This is exactly why smart money is moving early, repositioning ahead of the next Fed decision rather than waiting for confirmation. Let's talk about the scale of this move. Silver has now fallen sharply from its January all-time high near $121. For context, that earlier rally took silver from roughly $40 to over $120 in just over a year. That kind of parabolic move was driven almost entirely by dovish Fed expectations and a weakening dollar. When the narrative flipped, the unwind became violent, and here is the structural reason why silver moves so much harder than gold in both directions. The silver market carries an enormous paper-to-physical leverage ratio. Some estimates place that ratio above 20-1. That means when speculative traders exit their positions, the unwind is not gradual. It is fast, it is deep, and it overshoots in both directions. What happens next could shock most investors who assume silver simply tracks gold 1-to-1. It does not. Silver amplifies every move gold makes, for better and for worse. Now let's look at where this could go from here, because there are multiple paths forward. In the bullish scenario, silver finds support near its established technical floor. Multiple analysts have pointed to a zone that is held during every major pullback so far this year. If buyers defend that level again, this becomes simply another shakeout inside a longer-term bull market. Structural deficits in physical silver supply have not disappeared. Industrial demand from solar energy and electronics remains a long-term tailwind regardless of short-term Fed policy. If the Fed eventually pivots back toward rate cuts, and many believe that pivot is still coming, this entire correction could look like a gift in hindsight. But here is the bearish scenario, and you need to hear this. 2. If the dollar continues climbing and the Fed delivers an actual rate hike rather than just hawkish language, silver could break below its current support zone entirely. Some technical analysts have outlined a deeper downside range that would represent a much larger correction from the highs. If that zone breaks, momentum traders could accelerate the selling, and we could see a cascade similar to previous sharp corrections this year. This is the risk nobody wants to talk about when prices are falling. Leverage cuts both ways, and right now leverage is working against silver bulls. So what does this actually mean for you as an investor? Here is the honest truth. Short-term price action is being driven by Fed policy expectations and dollar strength. Long-term value is still being driven by something completely different: rising global debt levels, currency debasement across major economies, a structural supply deficit in physical silver that has persisted for years. These forces do not disappear because of one hawkish Fed meeting. They are still building underneath the surface, even while the price chart looks ugly in the short term. This is exactly why experienced investors separate price from value. Price is what the market is willing to pay today, influenced by sentiment, leverage, and short-term positioning. Value is what the asset is actually worth based on supply, demand, and monetary debasement over time. Right now, those two things have diverged sharply. And historically, when that gap opens this wide, it eventually closes, sometimes violently, in the opposite direction. Now here is something that almost nobody is connecting properly. The gold-silver ratio has become a critical piece of this puzzle. When silver falls harder than gold during a correction, that ratio expands. Historically, when that ratio reaches extreme levels, it has eventually reverted, often through a sharp outperformance in silver. Once sentiment turns, if history repeats even partially, the current weakness could be setting up the next leg of outperformance, not the end of the story. So where does this leave you right now? If you are a long-term holder, today's move is volatility, not necessarily a change in the fundamental thesis. If you are looking for an entry point, the next few trading sessions around the key support zone will tell you almost everything you need to know about whether this becomes a buying opportunity or a deeper breakdown. Either way, the next move from the Federal Reserve and the next reading on the dollar index will likely decide the immediate direction. Watch those two signals closely. They matter more than almost anything else right now. Let me leave you with this. Markets like this separate prepared investors from reactive ones. The people who understand the difference between short-term price and long-term value are the ones who tend to come out ahead when the dust settles. The people who panic at 4% moves often make decisions they regret months later. Which one do you want to be? If this breakdown helped you understand what is really happening in the silver market right now, make sure you are subscribed with notifications turned on, because the next few days could move fast. Drop the word silver in the comments if you are watching this support level closely. Drop the word gold if you think this is really about the broader precious metals complex. I will be tracking this story closely, and I will be back the moment something changes. Stay sharp, stay prepared, and I will see you in the next one.